This past month has been interesting because it's been basically an everything rally. I mean, bonds have rallied, stocks have rallied, gold hit a new all-time high. Bitcoin obviously is ripping. Um, do you guys think that it's all related around interest rate expectations now that the Fed has had messaging that they're going to maybe stop cutting rates or at least put an extended pause where they are? They're not going to keep cutting or raising rates. At least that's the messaging they're giving us. And do you think the market's just responding that the whole month of November with all these asset classes rallying basically together?
I'll give my 2 cents on it, and then I'm sure Dr. Jeff, part of his answer is going to be how he looks at liquidity. I always love when Dr. Jeff talks about liquidity on Cafe Bitcoin. But I think what you said, Sam, is certainly a factor. This Fed pause rally seems like it's the end of a hiking cycle. Kind of makes sense that financial assets would perform well on the back of that. I think there's one other factor that is people have been talking about recession coming for quite a long time now. And it just hasn't happened in the way that people have forecasted it. Maybe there's been slowdowns, there's been layoffs. We did have 2 quarters of negative real GDP growth, even according to the official numbers. But it just hasn't been the big recession that many people have called for. And I think that because so many people were calling for a big recession to happen, a lot of investors, capital allocators out there were positioning their portfolios in anticipation of something bad to happen economically. And I think that means keeping cash on the sidelines and more conservative investments, and that's also helped by the fact that they could get 5% in a money market fund. And now I think you might be starting to see a reversal of some of that. I don't want to call it a total capitulation yet, but I think you might be starting to see a reallocation of some of those people who were positioned very conservatively. And they're saying, okay, maybe this recession narrative I'm not believing it as much anymore. They just watched stocks, do really well so far this year in 2023. Last I checked, QQQ is up like 40 something percent. The S&P is up low 20s%. And some of this might be them chasing returns, right? I'm not saying that just because they're reallocating into these things means it's the right thing to do, but they might be looking at it saying, I was just positioned conservatively for the last 6 to 9 months. It didn't really pay off. I'm not seeing this recession. I'm going to shift and go into a little bit further out the risk curve. So I think that plus the Fed pause could be reasons for why we're seeing markets do what they're doing.
Yeah, I think those are great points. And so kind of to piggyback on that, a couple observations from past recessions were basically once you see the treasury market, the long-term, the 10-year yields are the best thing to look at, I think. Once you see those peak and then roll over, you get this little period where it's really interesting where people are buying bonds, so that's pushing treasury yields lower, and they're buying stocks. You get a bit of a blow-off top in equities, especially in NASDAQ type stocks. So it's very possible that this is happening. In fact, I think the peak happened in 10-year yields around mid-October. I want to say like around the 19th or so of October. If it's based on the 2000 and the 2008 cycles, what happened after the 10-year yield peaked is it took somewhere between 2 to 4 months, if you kind of blend those two time periods together, where stocks ripped higher before then they plummeted after that. So it's very possible we're having a bit of a blow off top right here. The other thing to consider is that it's also possible that we're not going to have the recession that everybody thinks we're going to have. It's possible, and I'm increasingly leaning into this camp, that we're actually going to have the soft landing that everybody kind of, everybody who's smart kind of smirks and giggles a little bit and says, you're so naive, you think it's possible to have a soft landing. Look at all these times where people thought it was going to be a soft landing and it wasn't. I actually think it's possible this time around, and I think it's possible we don't get a recession. I was, as you guys probably know, and maybe you were in the same camp as me, I was fully expecting a recession in 2022 and into the early parts of 2023. And it took me about a year to be like, okay, something funny is happening. Like, why are we not getting this catastrophic recession that it looks like everything is setting up for? I would argue that we were on our way to having the catastrophic recession in March of 2023 when the banks were starting to fail. And then the Fed stepped in and did the bank term funding program, and they did their kind of special maneuvers. It also happened a little bit before that with the gilt crisis in, I think it was September of 2022. Special things were done then that basically broke the dollar and broke the treasury yields. And then the Fed liquidity spike happened in March of 2023. I think those things are the reason why we haven't gone into a major recession. So I think they handle that. If you're into that sort of thing, they probably handled it well by pushing it down the road, and pushing it down the road far enough. I think it's possible that we will, we've been in a manufacturing contraction for over a year now in the US, but the services sector continues to be expansionary. So in the services sector, the US is basically a 70% to 30% or so services to manufacturing type economy. It's the services sector that continues to keep us out of a recession. And I just think that continues. I don't really see that changing anytime in the near future. And it looks to me, when you look at kind of the indicators and PMIs and those sort of things, I think we're at or close to a bottom in the manufacturing contraction. And if that spikes back up and turns expansionary again while services are still expansionary, we're not going to have a major recession. And I think we might see unemployment pop up into the low 4%, and people will be calling for, because that's a greater than 0.5% increase from the lows. I still don't think that means we're in a serious recession. I think my base case for 2024 is just kind of a low growth environment, low GDP. Inflation won't be spiraling out of control. And so that coming full circle makes me kind of bullish for risk assets as we head into 2024 as well. I don't see the government stopping their fiscal spending anytime soon. I think they're going to be doing a ton of new treasury issuance, and we'll see how that goes. But I think there's actually a market for that now, and we can get all that kind of stuff. So long story short, that's why I'm bull crabbish. I'm sort of sideways to up in general. And I'm not seeing massive, lighted up kind of growth, but I definitely think we still have low grade growth and we don't head into a major recession.
Yeah, I agree with a lot of that, or maybe all of that. And I think I don't want to play semantics, but I think it's up for debate as to is that a soft landing, or is that just a delayed hard landing? I could argue it either way, because I agree with what you said, Dr. Jeff. It's you kind of alluded to this. They didn't really solve these problems. They just kind of kicked the can much further down the road than people have thought. And I've kind of been putting together a list here of why this might be the slowest walk into recession potentially in history. Because most people would look at this and say, look, we just had very low interest rates and they've been raised. We all saw the stats at the fastest pace, I think, in US history. This has to lead to a recession. That's what people have been saying for many, many months now. But you look at what else happened during the last few years, and let's take a look at what preceded those rate hikes. In 2020 and 2021, corporations, both investment grade and high yield, issued record levels of debt and at record low coupons. So they got themselves funded for quite some time. Those corporate debt maturities don't really begin in a significant way until 2025, 2026. So can kick down the road for the corporate sector. The housing market, everyone remembers, was on fire in 2020, 2021. So many people locked in 30-year mortgages at a very low rate. Those people are not really affected by the increase in interest rates. And I should have said that for the corporate sector. The increase in interest rates doesn't really affect a company that just issued, what they normally would have issued over the course of 5 years. They issued it all in 2020 and 2021. They're okay that corporate yields are rising because they don't need to issue as much in the coming years. Same thing for someone who locked in a 30-year mortgage in 2021. Mortgage rates go up. It doesn't affect them as much. Massive government deficit spending. We all know what happened in 2020, 2021, whether it was stimulus checks directly to individuals, whether it was PPP lending. Another thing kind of in this category, which I just became aware of recently from an astute Cafe Bitcoin listener, actually. He let me know that small businesses were given hundreds of billions of dollars in emergency funding from the government. This is from the SBA, the Small Business Association, something called the Economic Injury Disaster Loan Program. So these terms, get a load of this: 30 years, fixed 3.75% rate, and there were no payments due on them for the first 2 years. So, I mean, talk about another can that's kicked down the road. And at first, I was incorrect on this. I thought it was only the large corporations who were benefiting from those easy times in 2020, 2021, easy monetary conditions, I should say. But small businesses through this program also got to kick the can down the road. So again, another thing that's going to lead to a slow walk into a recession. And then you have to look at what happened during the rate hikes. And Dr. Jeff alluded to this. We get a new Fed acronym made up program on a Sunday, BTFP, Bank Term Funding Program, that effectively insulates the banks from the effects of the rate hikes. Because you remember what that program is. The banks have treasuries that are underwater. That's causing a problem for them from an asset liability perspective. It's literally leading to bank runs. Those banks, instead of having to sell the treasuries and basically have what did happen to the gilt market before the Bank of England stepped in, they get to pledge those treasuries. Treasury could be at 70, 80 cents on the dollar. They get to pledge it at par and get a loan at par. So basically it's like, hey, you banks, you get to pretend like the rate hikes never happened. And then the last point, which Dr. Jeff also hit on, is we're deficit spending at somewhere between 6, 7, 8% of GDP right now. That's typically, you don't see that level unless you're already in a recession. So we have this weird dynamic where the US federal government is deficit spending like preemptively before we even go into the recession. So I know I just went into a ton of stuff there, but I think for those many reasons, that's why this recession that people have been calling for is just not coming. And then one final point I'll throw out there is, not to get too philosophical, but I think you two guys know that I often harp on this point that there's no such thing as prices, like in a singular measure of CPI. And people attempt to do it. That doesn't really exist. There's no such thing as the cost of living. There's also no such thing as the economy. And Lynn Alden has done a great job of this, saying that it's a tale of two economies. There are some people who are definitely being hurt by higher interest rates, no doubt. I'm not trying to minimize the effect of that. But it's just been a tale of two economies. If you're Microsoft, you issued a ton of debt at low coupons, you generate a ton of free cash flow, you put that cash flow at 5%, you're actually earning net income. That's completely different than a 23-year-old who just graduated college, didn't have the money to buy a house in 2021. House prices went up however much they did. Now mortgages are 7%, and he or she is priced out of owning a home. Completely, different thing. So I think it's important to remember that it's simplistic to talk about how is the economy doing, but it's obviously much more complicated than that under the hood.